All right, so just to start off again, today what we're going to be talking about is generating consistent income using options. For those of you who are new to OptionsPlay, today we're going to show you some of the techniques that we use to quickly help you identify income opportunities for covered calls. A lot of you have seen this webinar before, and for those of you who have seen before, at the end I'm going to add a little bit to this, to what I usually do, and show you what you guys can do in terms of generating an income if you don't have 100 shares of the underlying stock. So aside from that, we're just going to jump right into it. I hope everyone had a good holiday. This is a new year, so we're going to be looking at the new, using covered calls to generate some new income for you guys. So today we're going to talk about the techniques on how to do that. So the key word here is focusing on how to generate consistent income. Most of you are familiar with covered calls. Most of you understand the concept of it, but when it comes to generating consistent results month after month, quarter after quarter, that's where we tend to see clients all over the map. So today we want to talk about how to identify the setups for income strategies that will give you consistent income month after month. And then more importantly, what I want to show you guys, for those of you who are new, is not only learning how to do this, but having the tools so that you are confident being able to apply this month after month, even when sometimes when you have some losses, and when we're trading covered calls, it can't be avoided. Sometimes a stock just shoots up and you lose a lot of money on the short call. How are you able to consistently get around that and feel confident that you're still using the correct cover calls each time? So that's really what we're going to talk about today. I'm just going to leave this slide up for a couple of seconds. For those of you who can't hear me, the best thing to do is to dial into the conference line. If you can't hear me through the computer, dial through the conference line. That's going to be the only way you'll be able to hear this webinar. So today we're going to be talking about cover calls, basics, and benefits. This is really for those of you who are unfamiliar with cover calls. So in the chat window, for those of you who have traded cover calls or understand cover calls, if you could just type in yes. And for those of you who are new to cover calls and have never traded a cover call and don't understand it, just type in no. This way I have an understanding of the audience. So it looks like vast majority of you are yes, a couple of no's here. So for those of you who are new, welcome. We're going to be showing you some of the basics on how to generate income. And for those of you who have traded them, we're really going to show you how you can make your cover call opportunities, your income opportunities, much more efficient, and show you how you can do this very quickly using OptionsPlay. So before we get into, once we cover the basics, before we get into the actual steps and how to pick the optimal income strategy for your portfolio, we're just going to talk a little bit about individual preferences. And the reason for this is because there's a lot of you on this webinar, and each one of you has different preferences. And when it comes to how often you trade, to your risk tolerance, each one of you is different. So what we want to identify is kind of how each one of you are different, and then we'll go into how you can use those preferences to set the optimal cover calls for yourself. Then we're going to talk about the two crucial steps to consistent income. They're actually two very easy steps once you understand your individual preferences. And then lastly, we'll show you how to automate that using the OptionsPlay platform. And then if we have time at the end, I'll touch up on some of the exit strategies or what you can do to manage your cover calls. And like I said, just at the very end, for those of you who have viewed this webinar before, we're going to talk a little bit about what you can do if, let's say, you don't have 100 shares of the stock, or if you don't own the stock. How can you still take advantage of income opportunities on a given stock? So we're just going to jump right into it. Just for those of you who are new, just a couple of basic benefits and limitations of covered calls. When you're writing a cover call, you're selling an out-of-the-money call against 100 shares of stock that you own. And what that does is by selling a call, whether you sell a call every week or every single month, that generates consistent income, because the idea is to sell a cover call every single month, and once it expires, you sell another call, and that generates the income stream that you're looking at. By doing so, what you're actually doing is you're actually lowering the volatility of your overall portfolio when you bring in that income stream, and you're lowering the net cost basis of the stock that you're owning. So those are some of the benefits. and you can use it on any stock that you own in your portfolio that has listed options on them. So that's really the key parts of the benefits. The limitations are it limits the upside return of a stock. So when you choose an out-of-the-money cover call, you are giving up any upside of that stock above the strike price that you've selected. So, but only for the time frame of the call option. So if you sell a 1-week call, you're limiting the upside for that 1 week. If you sell a 1-month call, you're limiting the upside for 1 month. And it does require 100 shares of the underlying stock. So if some of you, a lot of times I get questions from users, they want to sell stock cover calls on Apple, but maybe you don't have 100 shares of Apple, or maybe a higher price stock like Priceline or Netflix or Tesla, you might not have 100 shares of that. So it does require at least 100 shares of that stock to sell one cover call, and you do at the end of the day risk losing your stock. And we'll talk about how you can minimize that risk by you taking the steps that we're going to outline in this webinar. So once we have an understanding of what a cover call is, before we get started in talking about how to select the optimal cover call for your portfolio, we're just going to talk a little bit about individual preferences, because again, one size does not fit all, and each one of you have different preferences that you need to look at in order to find the optimal income strategy. So first thing we want to look at is time frame. Every one of you may trade on a different time frame. I happen to have the time to look at the markets every single day and look at my portfolio every day. So I'm more active. So I'm going to be looking at, if you look at my screen, there are 3 time frames that we've selected: short, medium, and long term. For an active trader like myself, I would fall under the short term. So when I'm looking at any type of income strategies, whether I'm selling cover calls, whether I'm short puts, and this can be extended to any type of credit spreads that you might be doing for income strategies, you want to be looking at expirations anywhere from under a month to no more than 2 months out. If you're an active trader, look at short-term opportunities, because you're better able to predict what may happen in the next couple of weeks than you will be able to predict what can happen in the next few months. The shorter the time frame, the more certainty you may have. The longer the time frame, the less certainty you generally have. So for those of you who are active, you're going to be looking at expirations that expire anywhere from a few weeks to no more than a month or 2 out. On the other end of the spectrum, you may have a long-term investor. So this is typically for those of you who buy a stock and maybe hold on to it for years, and you might only look at your portfolio once a quarter or once every few months. You would be more so on the long-term scale, and you're going to be looking at expirations anywhere from 3 to 6 months out. And then a lot of you are somewhat in between. You're not looking at your portfolio every day, but you probably look at it every single week. You're not a long-term investor, meaning you're not just looking at it once a quarter. You're going to be somewhere on the medium term. So you're going to be looking at expirations anywhere from 2 to 3 months out. So before we move on, just make a little mental note to yourself where you fall under in terms of how active you are with your portfolio, how often you look at it, and determine whether you fit into the short, medium, or long term when it comes to income opportunities. And again, this is not just for cover calls. This is for credit spreads as well. This is for short puts, all different types of income opportunities. We're just going to be talking about cover calls mostly today. Next, once we have an idea as far as what time frame we fall under, we're going to be talking about risk tolerance. Each one of you will have different risk tolerances. So on the conservative end of the spectrum, your main objective is keeping your stock. This is, generally speaking, the type of traders or investors who may have owned their stock for a long time. Maybe you've held onto a stock for years and you really don't want to lose the stock because it'll generate a huge tax bill. Or maybe you own the stock for dividends and you rely on the dividends for income, and you really don't want to lose that stock because you rely on those dividends. Then your main objective when it comes to risk tolerance is being conservative in keeping your stock. On the other end of the spectrum, for those of you who are high risk takers, who are really looking to maximize your yield and your return, and you're willing to take that risk, you would fall under more on the aggressive end of the spectrum when it comes to risk tolerance. And then most of you will probably fall somewhere in the middle. You're looking for a balanced risk to reward balance. You want to balance the amount of risk you're taking versus the income that you're going to get from the strategy. And for those of you who fall somewhere in the middle, you're going to be looking more so on the optimal risk tolerance scale. So just make a mental note to yourself what time frame you fall under, what risk tolerance you fall under, and that's what we're going to be using in OptionsPlay to help you quickly find the optimal cover call or income strategy that suits your portfolio. Now that we've talked about the two individual preferences that you need to be thinking about where you fall under, the two crucial steps to generating consistent income is actually really simple. Number one is you just want to choose an expiration and strike price based on your preferences only. Meaning if you're short-term, pick only short-term options, a few weeks to a few months out. If you're an aggressive trader, you only look at aggressive option strategies. And what does conservative, optimal, and aggressive mean? So you don't have to memorize this because this is what OptionsPlay is designed to do, but I do want to highlight to you the difference between how you select your strikes if you're conservative, optimal, or aggressive. So on the conservative end of the spectrum, when you're trying to select a cover call to sell or a short put to sell, you're really looking for something that has approximately a 90% probability of that call or put expiring worthless. Now, that may not be a metric that most of you are familiar with. For those of you who have used OptionsPlay, you might be familiar with that. For those of you who haven't or maybe used other trading platforms, delta is the closest approximation that you can use to approximate the probability of a call or a put expiring worthless. So when you're shooting for a 90% probability of expiring worthless, you're looking at a 10 delta call. So for those of you who are familiar with using an option chain on another platform, you might be more familiar with delta. And the concept of 90% probability of expiring worthless is the idea that if you sell 10 cover calls, you would expect 9 of them to simply expire worthless, where you keep all the premium, and then 1 out of those 10 calls, the stock will actually shoot up above the strike price, and you may lose your stock. So when you're on the conservative end of the spectrum, you really want to make sure that the number of calls that expire worthless is really, really high, or a very low delta when you're selecting your strikes. On the other end of the spectrum, if you're aggressive, you want to shoot for something around a 70% probability of expiring worthless. So out of 10 cover calls that you sell or 10 puts that you sell, you would expect 7 of them to expire worthless and 3 of them potentially losing your stock. And again, this is for those of you who don't care if you lose your stock, and you would actually prefer losing your stock because that means that you gain the quick return or the quick rise in the stock price. And for those of you who are unfamiliar with probability of expiring worthless, you're going to be looking at a 30 delta call. And then again, like most of us, we're going to fall somewhere in between there. We're going to be under the optimal risk tolerance. This is where we're shooting for about an 80% probability of expiring worthless. So out of 10 calls that we sell, 8 of them will expire worthless, or a 20 delta call. So these are the 3 targets that you want to shoot for: is only selecting an expiration date that fits your time frame, and only selecting a strike price based on your risk tolerance. Now, again, this is for illustrative purposes to show you guys what the targets are. You don't have to memorize this, and this webinar is recorded, so you can always come back and view this information if you'd like to, but OptionsPlay will already automatically do all of this work for you. So you don't have to memorize this. So number 1, choose an expiration and strike price only based on your time frame and your risk tolerance. Number 2, once you've selected your expiration and strike price, then you want to look at the return of that cover call that's selected for you. And a lot of times I get the question, how do I know if the premium in a cover call is enough? I have a lot of users who will say, I will only sell a cover call if the premium is at least $1 or at least a certain amount. And that's not always a great way to gauge whether there's enough return for it, because $1 on a stock that trades at $100 is not a lot, but $1 for a stock that trades at $20, it is a lot from a percentage standpoint. So you can't just always use a fixed dollar amount. So what we use is an annualized return. So on OptionsPlay, we calculate the annualized return for each cover call that you look at. And how do you determine whether that annualized return is sufficient or not? And I always tell users to use the dividend yield as your guide. So if you're selling a cover call and it's yielding 5% on the cover call, then you want to look at the dividend yield. If that stock that gives you a 5% return on the cover call only has a 1% dividend yield, then you're essentially bringing your total yield from 1% to 6%. That's a great cover call to be looking at because you're increasing what you were getting on the yield from the dividend by 500%. Vice versa, if let's say you're writing a cover call and the annualized return on that cover call is only 1% and the stock pays a 5% dividend, then that's not very attractive anymore because you're originally getting paid 5% yield. By writing a cover call, you're only boosting that from 5% to 6%. That's not as a compelling reason to take the risk of selling a cover call. So use the dividend yield as your guide. As a rule of thumb, I usually try to at least beat the dividend yield. Some of you may go for three-quarters or even a half of the dividend yield. It's up to you, but I usually, as a rule of thumb, will use the dividend yield as my absolute guide to determine whether the cover call I'm looking at gives me enough yield to take the risk. So those are the two steps that you really need to focus on, is making sure that you select a strike based on your preferences, which I will show you how to do that using OptionsPlay. And then step 2, use the dividend yield as your guide to determine whether there's enough yield. So with that, what I'll do is I'm just going to jump right into OptionsPlay and actually show you guys how to do this. So this is the OptionsPlay platform. For those of you who are new to this platform, I'm just going to give a quick 2-minute overview. On the left, we have our trade ideas and watch lists. In the middle, we have our equity analytics panel. And on the right, we have trading and income. These 3 panels, we call them the what, the why, and the how of options trading. Because what you want to, the trade ideas and watch list gives you which stocks you want to look at today. The middle panel tells you why you want to look at it. And the trading and income panel tells you how you can take advantage of the underlying stock. Whether you have a bullish or bearish view on the particular stock, or if you're looking for income strategies, you click on the income tab, that will show you income strategies. So today we're going to focus just on the income part because that's what we're talking about today. Now, when you click on the income tab for any symbol, you're going to notice there's always going to be 2 strategies. On the left will always be your cover call. On your right will always be a short put. So what we're always going to be able to show you is a cover call idea and a short put idea for every single stock that you type in. So if you type in Apple, you'll get a cover call and a short put. Now, before we talked about only selecting an expiration date and strike price based on your personal preferences. So when you click on the income tab, first thing I want everyone to do is go down to the bottom where it says default settings, because before we look at any cover calls and short puts, we want to make sure that we set the time frame and risk tolerance based on your personal preferences. So for me, because I'm a fairly active trader, I'm going to be looking at more on the short-term end of the spectrum when it comes to time frame. And for risk tolerance, right now the markets are pretty toppy. I think it's time to get pretty aggressive with your cover calls. We've had a large bull run, so at this point I don't necessarily think the stock's going to go too much higher. So I'm going to be pretty aggressive when it comes to risk tolerance. So I've selected short-term and aggressive. You can select whatever time frame that suits your criteria and whatever risk tolerance that suits your risk profile. And once you do that, all you have to do is click on Save as Default. Once you do that, and for every symbol that you type in, OptionsPlay will go out and find the cover call or short put based on both the time frame and the risk tolerance that you've set. So when you click on a symbol, you might see a different result than what's currently showing on my screen because you will probably have different preferences. So this is custom tailored to your needs, both on time frame and risk tolerance for any symbol that you type in. So before we go on and actually go through some real-life examples, I want to tell everyone, go ahead and set up a watch stocks that you own, or maybe stocks that you want to own, or stocks that you want to write cover calls on, or stocks that you want to generate income on. Set up that watch list because it's going to make your life a lot easier and allow you to go through 20, 30, 50 symbols in a matter of minutes because OptionsPlay is already set up for your time frame and risk tolerance. All you have to simply do is click on a symbol, and OptionsPlay will immediately go out and find the cover call and a short put that meets your criteria. So let's look at Tesla for a second. Tesla's trading at $226.99. What this is telling me is that if I'm interested in selling covered calls, first thing it's going to do is ask me, do I own shares of Tesla? So I can say I own 100 shares of Tesla. I can type in a cost basis, and it immediately tells me that I can sell the January 27th, 237.5 covered calls. So Tesla's trading at 226 right now. This is telling me to trade a 237 covered call, so about $10 out of the money. And this expires in about 23 days. So this is telling me to sell a covered call that expires in 23 days. That's about $10 out of the money. It's telling me that I'm going to bring in $380 in premium, which translates to a 26% annualized return. That's pretty high considering Tesla actually pays no dividend. So if you own the stock, you're currently getting no yield just for owning the stock. The only gains you're getting is from the appreciation of this stock. So you're not getting any income, you're not getting any dividends. So writing covered calls is the only way to boost that yield. So you're boosting your yield from 0% by about 26% by selling short-term covered calls against it. So this is a pretty short-term call. This expires in 23 days, gives me a 26% annualized return. Now, Tesla is a pretty high volatility stock, which is why you're getting such high yields. So let's take a look at another stock like Home Depot. Home Depot is not as high-flying stock as Tesla. So when I click on Home Depot, I get Home Depot's trading at 135 right now. This is telling me, again, I can type in the number of shares that I own. Let's say I own 100 shares of Home Depot. Now it's telling me that I can receive $96 in premium. And again, remember, selecting this expiration and strike, if you're using an option chain, will actually take you quite a bit of time to go through, pull up the chain, pull up the different expirations, then choose, then you may have to remember what delta you're looking for, a 10 delta, 20 delta, 30 delta, depending on your preferences. Then you might look at, one expiration. Perhaps you don't find anything there, then you go to the next expiration. It's a very manual process, and there's a lot of room for error. So what OptionsPlay does is it takes out that manual searching process and already goes out and searches based on your time frame and your risk tolerance and returns to you the covered call that meets your criteria. So in here, it's telling me for Home Depot, if I own 100 shares, which closed at 135.5 today, this is telling me to sell the 139 covered calls that expire in 23 days. So this is, again, about 3 weeks out. I'm going to gain about $96 in premium. This is 11.24% annualized return. This is a stock that only pays a 2% dividend. So if I'm selling covered calls in this particular case, then I'm going to be able to increase my yield from 2% to about 13% here by selling covered calls against Home Depot. So, and once you've set up this watch list, what it allows you to do is simply go through a list very quickly. And I do want to show you guys something. So let's say HPQ, I believe, is a good example of this. So notice how the first few examples I went through from Tesla, from Home Depot, I get this green check, I get this green bar and a check mark. What this does is it means that OptionsPlay went out, searched for the time frame and risk tolerance that I set, and was able to find me something. But if you notice on HPQ, I get a slightly different message. It's a blue bar with a red warning sign. So let's go through this again. Let's say I own 100 shares of HPQ. Once I move my mouse over that little red warning sign, it'll tell me OptionsPlay could not find a cover call based on the short-term aggressiveness preferences that I have, and it's displaying to me the next best alternative. In this particular case, it's a medium-term aggressive. So when OptionsPlay is not able to find something that meets your criteria exactly, it will tell you that, but it will also at the same time provide some alternatives. So if you want to look at some alternatives, it provides that to you. So here, it didn't find me a short term, which is my personal preferences for active trading. It found me a March expiration. So HPQ is trading at 15 right now. This is telling me to sell the March 16 covered calls. So that expires in 72 days. So it's a little further out. And as you can see, this stock has earnings in the next in about 50 days. So this is going to include the next earnings cycle. It adds a little bit more uncertainty to it because a lot of things can happen during expiration. And it's giving me a 12% annualized return. So this is a stock that pays 3.5% on dividend yield. So I'm going to increase my annualized return by 12%. This is still, from my perspective, perhaps attractive because it's giving me a significant boost to my yield. But I do know in the back of my head this is outside of my personal preferences. And that's the #1 rule, is don't trade outside of your personal preferences. So it's up to you whether you want to do it. My suggestion for you is that when you come across this warning sign, that just means it's okay. We couldn't find an optimal cover call for HBQ this time. Don't force yourself to do it. Don't force your way into a trade that's not suitable for you. So this allows me to say HBQ, not suitable for me, and allows me to move on. So then I can go on to Goldman Sachs and see if we found an optimal cover call for Goldman. Same thing. Now I can, with this tool, I can easily go down a list of stocks. Let's say you own 20 stocks. You can quickly go down very quickly and see which stocks have a cover call opportunity or an income strategy for you, which ones don't. And for those that don't, you'll be able to very quickly see that just by looking at this blue warning sign. So for example, for Con Ed, it's telling me no cover call based on my personal preferences and allows me to just move on. I no longer have to manually search the option chains, because before you would have to search for Con Edison, pull up the option chain, go through the expirations, and maybe after going through all the expirations, then realize, hey, there's not really something that meets my criteria. And now I've wasted all this time looking through it just to find out there's nothing there. This makes it so much easier for you, because if there's nothing that meets your criteria, it'll give you that blue warning sign and it just basically tells you to move on. And this is again designed to save you guys time, not only help you guys quickly find the optimal income strategies for you, but also at the same time avoid bad ones. Just so you know, we're gonna leave all the questions at the end. So you guys can hold off on your questions if you can to the end. We're going to have a Q&A session at the end. Now, once let's just look at Chipotle here, right? It's trading at 380. This is telling me to sell the January 27th 400 cover calls. Let's say I own 100 shares of Chipotle. This is telling me I'm going to receive $400 in income, which is a 16% annualized return on a stock that currently pays 0 dividends. This is a great way to boost your yield, especially if you're owning stocks that pay no dividends, because you have no income currently holding onto a stock like this. So writing cover calls is a great way to boost that income. Now, once we've honed in on a cover call that maybe you're interested in trading, let's say you own 100 shares of Chipotle and you're looking at this January 27th 400 call and you're thinking about entering that into your brokerage firm. Before you do, I suggest every single time you do that, click on the trade button, which first of all will give you the details that you need to enter into your broker's platform. More importantly, we have a thing called a strategy checklist. What this is looking at is looking at the probability of expiring worthless. Does it fit in the range that you're looking for? So this is telling me that it has a 74% probability of expiring worthless, which is slightly lower than optimal. The strategy has a 16% annualized return, which is good. There are no earnings between now and expiration. We built this because of out of necessity. Sometimes when you're writing cover calls or sometimes when you're trading and you're trying to get a trade out there fast, you may overlook some of the small details. So that's why we created this strategy checklist, just to make sure that you understand all your risks before you place a trade. It's very common sometimes to forget about earnings and know if there's earnings between now and expiration. So this just checks that for you and lets you know, is there earnings between now and expiration? And then lastly, spread and liquidity. This is a question we get asked a lot, is how do we determine whether something's liquid or not? And 9 out of 10 times a customer will ask me, do I look at volume or open interest to gauge liquidity? And my answer is always, that's not the best way to gauge how liquid something is. There's plenty of very liquid options that have very little open interest or volume, and there are plenty of options that have very high open interest that are not liquid at all. So open interest and volume, a good majority of the time will tell you whether something is liquid or not, but it's not the best indicator. Looking at the spread between the buy and the sell price is a much better indicator. So as you can see, this Chipotle is trading at, even though I'm getting $400 in premium, it's trading at $4 by $7.10. That's a huge spread between the buy and the sell button. Between the buy and the sell price. That's why we have this red warning sign telling you the bid-ask spread on this trade is very large, and if you want to trade it, try to place your limit price near the mid price So what we're also looking at is these risks that you're looking at for every single trade. So let's go back to like Apple, which is one of the most liquid that we have options on. Let's do that same exercise for that Apple trade. So now I'm looking at the January 27th, 119 cover call. When I hit trade, I get a slightly different message, right? Probability of expiring worthless is a little lower than expected, 70% probability of expiring worthless. There's an annualized return of 13%, which is great. This is telling me there is earnings between now and expiration, so that's one other thing I need to consider is, do I want to sell a cover call into earnings? In this particular case, it's on January 24th, which is very close to the expiration date, so maybe I still might want to sell this cover call and just close it out before earnings. And then lastly, it's telling me the bid-ask spread is sizable, but it's not as bad. So as you can see, it's trading at 101 by 110, so a little under 10% of the cost to the spread. So it's telling me to place my limit price at 106. So this is, again, I highly recommend before you place any trade, whether you're trading income, whether you're trading, just buying a call or buying a spread or any option strategy, click on the trade button on OptionsPlay and look through the strategy checklist. We want to make sure that you understand the risks of each trade before you place it, and most importantly, understand how liquid something is before you trade it. Because the last thing you want to do is sell a cover call that you can't get out of because the spread is too wide. It's better to know that before you trade it than after you're in the trade. So once now that we've looked at how to use OptionsPlay to quickly identify what is the optimal cover call or short put for your portfolio, I do want to talk a little bit about some minor adjustments. What I mean by that is sometimes each one of you may have, maybe for the most part you fall under the optimal risk tolerance, or maybe for the most part you fall into the conservative risk tolerance. But maybe you have some stock that you want to take more risk on, or some stock that you want to take less risk on. So maybe for Apple, I'm fairly aggressive when it comes to risk taking, but maybe I've owned Apple for a really long time and I really don't want to lose the stock, and I depend on the dividends on the stock to pay my bills or whatever it is. To make minor adjustments to this, there's a button here in the bottom called the Options Grid. What this does is actually allows you to not only look at the cover calls that meets your criteria, but it looks at the whole spectrum. So it allows you to look at the different time frames. So we talked about the different short, medium, and long term. And then also at the same time allows you to look at aggressive, optimal, and aggressive. So maybe for Apple, specifically just on Apple, I want to be very conservative. So what this allows me to do is make some adjustments and say, no, I don't want to be aggressive on Apple because I've owned the stock for a long time. I want to be conservative. It allows me to look at selling the January 27th, 123 calls as opposed to the 119 calls, which are more aggressive. So this allows you to make minor adjustments when you need to. Again, this is not recommended to do this all the time, but again, sometimes for some stocks you just want to get more aggressive or get more conservative. You can use, again, this options grid button here on the bottom to see what are the other available options that are there. So with that, again, this wraps up what I was saying regarding, take the time out before you look at any income opportunity, whether you're looking at the right cover calls, whether you're shorting puts. Go to the default settings button on the bottom of your income panel before you do anything, and look at what time frame do you fall under for cover calls. Think about what your risk tolerance is for cover calls. And for those of you who do short puts, there may not be many of you here, but for those of you who do, you can set these independently of each other. So the short put that we find for you may be a different risk tolerance than the cover calls that we find you, so that you can set these independently from each other and then save as default. Once you do that, it'll allow you to go through a watch list of the stocks that you own or the stocks that you're interested in looking at, and very quickly, within seconds, immediately identify, is there a income opportunity for that underlying stock or not? If there isn't, go ahead and move on, go to the next one, and you can go down a watch list of 20, 30 names in a matter of a minute or two, and very quickly know which symbols have an income opportunity for your portfolio. So with that, I'm just going to jump right back to the spreadsheet a little bit because I want to talk about some of the exit traps. So writing cover calls is getting into the trade or finding the trade to get into is half the battle. The other half of the battle is what do you do once you're in that cover call? And essentially there's three scenarios that, there's so many different scenarios that could happen, but the three major ones that can happen is the stock rises significantly higher. So let's say Apple's trading at 116, you sell that 122 cover call, and immediately the Apple just takes off. Maybe some news comes out, and it just goes significantly higher. In that particular case, generally the rule of thumb is to don't panic, okay? You want to hold that covered call, despite the fact that Apple shoots up in the short term. You generally want to hold that covered call, and if you need to roll it or if you need to close it, only do that within the last week of expiration. And the reason for that is because A, you want to give it time. Apple shoots up very quickly, it may actually come back down. So you do want to give it some time. You don't want to just lock in those losses by closing it out early. You want to hold on to it for as long as you can, which gives Apple the stock the opportunity of coming back down. At the same time, what it does, it allows you to take advantage of the full time decay, which is what you want when you're short a call. You want that time to decay, and that's part of your profits. So if you don't hold on to it, you're not going to get that part of the profits. So if the stock shoots higher, try to hold on to it. I know it's tough, but you generally want to hold on to it and roll it or close it only within the last week before expiration. In another scenario, let's say you own Apple stock at 116, you write a 122 cover call against it, and the stock goes sideways. This is kind of the most optimal or the most preferable path, if you will. What that means is that your call expires worthless, and this way you can hold your position all the way till expiration. The call expires worthless. You keep the money from the covered call. Lastly, you might sell a 122 cover call on Apple when it's trading at 116, and next week something bad happens and the stock plummets. This is really the only scenario where you want to either close out or roll your position early, because what happens is the stock really plummets, that call is going to be worthless much sooner than expected. Then that is the only time where you want to lock in those profits. You can roll that position down. You can sell maybe a 116 call against it if the stock goes down to 110 or 105. That's when you want to close early and potentially lock in your profits, or roll it and lock in your profits. So those are the three scenarios that you can use when you're selling a covered call. So that concludes kind of what I wanted to talk about, which is showing you guys what are the different preferences, what you want to look for to choose the correct expiration and strike price for your covered calls, show you how you can use it and set it up in OptionsPlay so that you can quickly look at the stocks that you want to look at, quickly identify the income strategies that fit your personal preferences, and be able to have the tools that you need to confidently place a trade on your brokerage platform. Now, I've done this webinar a couple of times now, and the feedback that I get has been great. A lot of you have been using this tool for this purpose, but one of the things that a lot of you say is that you may not own always 100 shares of that underlying stock, or maybe you don't own that stock at all, but you want to generate some income. So today, what I do want to talk about is how you can still potentially generate some income without owning the stock. And it's still the same process. So let's say Goldman Sachs, and this is actually a trade that we highlighted from the CNBC trades that we send out every single Friday. This was a trade that we highlighted, I want to say 2 weeks ago. We thought Goldman wasn't going to go any higher, around this 240. So what we looked at is how to sell a credit spread, selling a call spread or a put spread, in order to generate some income on a stock that you don't own 100 shares of. So what we can do is you can still use the same process of identifying which call to sell. So for example, Goldman's trading at 243 right now. What you can do is you can still sell those 252.5 covered call, or you can still sell those 252.5 call against it, but most of you don't have the ability to sell naked calls, nor do I recommend you to ever go out and sell naked calls or short puts on a stock that you don't really know, or a stock that you don't really know a lot about, or a stock that you don't really want to own or end up being short. There's a lot of risk when you're talking about naked short calls or short puts. So what you can do is you can sell the 252.5 calls against it, but in order to cap your risk and limit your risk, you have to buy back a higher call. So let's look at that real quick. What you can do is you can click on and this is a bit more advanced, and this is really for those of you who have used OptionsPlay for trading purposes. So if you're new to this, it might be a little difficult to follow along, but I'm going to try to show everyone how to do so. We do have a completely separate webinar just on trading strategies. I'll be doing one next week. So for those of you who are new to this platform, I highly recommend you to come to that, and that will highlight a little bit more what I'm going to show you guys today. So let's say we're going to sell the January 27, 252 covered calls. So what I can do is I can modify this. I can sell the January 27, 252.5 calls. So like as it said, by selling the January 27, 252.5 calls, I'm bringing in $3.20 in premium. But in order so that I'm not short a naked call out there, what I'm going to have to do is I'm going to have to buy a higher call. So I can buy I'm selling the 242.5s. I'm sorry, 252.5s. So I might have to buy, let's say, a 260 or maybe a 262.5 call against it. And what that does is it caps my downside risk. So what I can do is I can sell the 252.5 calls for $3.20 and then buy the 262.5 calls for $1.44, which brings my net credit to $1.76. So instead of bringing in $3 and how much is this? Instead of bringing in $320 by selling just the call, by selling a call spread, oh, no, it's not, sorry. So by selling that call spread, vertical, January 27th, what did we say, the 252.5 to 62.5? So instead of bringing in $3.20 in income, I'm only bringing in $1.76. But I can do this without owning 100 shares in stock, which obviously costs a lot of capital to do. So this is another way that you can write call spreads or put spreads. So maybe I can, if let's say you're bullish on Goldman and you don't want to sell an upside call spread, you can also do a put spread. And to figure out which strike to sell, you use the income panel. So let's say I want to sell the 232s against it, and then buy back the 222.5. So I'll bring in, So I'm selling the 232.5 puts, bringing in $3, buying the 222.5 puts, bringing in $1.42. So this brings a net credit of $1.57. So these are two ways that I can still generate some income on Goldman Sachs if I own none of these, if I don't own 100 shares of that stock, is I can sell an upside call spread if, let's say, I'm bearish on the stock, or I can sell a downside put spread or put credit spread if I'm bullish on the stock. So you can still use this income tab for those of you who don't own 100 shares of the stock to still look at selling a downside put or an upside call, even if you don't own 100 shares of that stock. So I did want to this is a bit more advanced. This is for those of you who have seen this webinar before and are looking how to apply this to stocks that you don't own or don't have 100 shares on. You can use these this short call and this short put price to still sell those puts and calls, but you just have to buy back a further out of the money call in order to cap your risks. So with that, I'm gonna open this up for Q&A. So for those of you who are new, there's a chat window to your left. You can type into the chat window, and that will allow me to answer any questions you guys have. So the first question I have here is, what is the red bar next to Chipotle Mexican Group? And I'm going to presume you mean this little red bar here. So when you set up your watch list, as you can see, some of these have green bars, Chipotle has a red bar, some of these have yellow bars. But that's really looking at as a 1 month and 6 month trend indicator that we have here. As you can see on Chipotle, the 6 month trend is bearish. That's why you get this red bar. So the bar here on the left is your 6 month trend, and the 1 month trend is your little arrow here on the right. So what this allows you to do is, without even having to pull up the symbol, in the middle panel, you can just look at your watch list and immediately know which stocks are currently in a bullish trend, which stocks are in a bearish trend. As you can see, there's not many here that are bearish, and that's not too surprising considering we've been in a very strong bull market. So most stocks like Morgan Stanley, you have both the 6-month trend is bullish and the 1-month trend is bullish. That's why you get the green across the board. And for, let's say, Johnson & Johnson, I know the 6-month trend is neutral, but the 1-month trend is bullish just by looking at my watch. So that tells you whether something is bullish or bearish is this green and red bar here in the left. Do you have any plans to offer even shorter time frames, less than 20 days? That's a great question, David. And this is referring to the time frame that we're talking here. So if you're on the short end of the spectrum, like I said, our preferences for short term is somewhere between 20 to 49 days. David, the reason we don't have anything less than 20 days is really because when you go to the cover calls that are less than 20 days, unless you're selling an at-the-money call, there's really just not enough premium. And that's really why we're looking at least 20 days out, because that's really the first expiration. We're going to find enough premium where you're going to, especially if you're a retail trader, you're probably paying anywhere from $5 to $10 on your commission, plus anywhere from 25 cents to $1.25 per contract. Just to overcome the commission alone, you're going to need at least 25 cents, if not more, just to overcome your commissions. So that's why we generally look at no shorter than 20 days, because if you go any shorter, you'll be able to find very few stocks will have enough premium to write cover calls on. So that's really the reason why we use 20 days as the minimum. You mentioned, so Keith is asking, you mentioned earlier income from a worthless option lowers your cost basis in the stock. No, I don't. No, I think maybe there was some misunderstanding. I think what I'm referring to is by selling cover calls, you're lowering the cost basis of the stock. What I mean by that is, let's say you own Johnson & Johnson at 115.65. So let's say you own 100 shares at the current market price. When I'm saying it lowers your net cost basis by selling the cover call is your cost basis is essentially $11,565 to own 100 shares of the stock. But if you sell a cover call, you're actually reducing that by $86. So you're reducing your cost basis from $115.65 down to $114 and change. So that's what I meant by lowering the net cost basis. It doesn't lower the actual cost basis, but the net effect of a cover call is that it lowers your cost basis. David is asking, what difference, if any, does monthly versus weekly options affect platform strategy? So that's a really good question, because this is a question that we've been getting a lot lately. And this is something that is actually, I can't help but say, getting worse. But what we've recently been finding is on the monthly options, and just so you know, we don't differentiate between weekly and monthly options. We'll look at all options as if they're the same, because in reality, whether it's a 20-day option, a 30-day option, whether it's weekly or monthly, it doesn't matter to us. But one thing we have noticed is that the weekly options have much finer strikes, which gives you much more accuracy in trying to find the strikes that meet your criteria versus the monthly options. What I mean by that is, let's say we pull up a monthly option, which is the January 20th expiration. As you can see, I get dollar strikes between looks like the monthly expirations, now that they have dollar strikes, which is pretty good, because I can fairly fine-tune what I'm looking for. But as you notice, above 135, they go into $5 strikes, which makes it a lot harder to find the strikes that you need. Versus if, let's say, the January 27th, so it looks like they've introduced dollar strikes on Apple here. Let's look at February real quick. Yeah, so if you look at just February expiration, which is a monthly option, as you can see, I really don't have a lot of choices, right? So Apple's trading at 116. So the first out of the money is the 120. The next is the 125. That's a very big jump from one strike to the next from a percentage standpoint. Versus if I traded the weekly options on February 10th, as you can see, I got dollar strikes. So I can choose the 116, 117, 118, 119. So I have much more ability to find the strike that meets my exact criteria that I need. So that is the one difference that we've recently noticed more and more so between the weekly versus monthly options, and that's kind of why I prefer trading the weekly options, because I'm able to find the strikes that I need exactly, versus the monthly options. A lot of times I'm not getting that same flexibility because the strikes are $5 apart. So we see this across the board, across a lot of different symbols. But from our perspective, we'll look at anything. We'll look at monthly options, we'll look at weekly options, but just a personal preference of mine, at least that I've noticed, is the weekly options have more strikes, which makes it easier to find. Ray is asking, when can we see the recording? So everyone that's registered for this webinar, once the recording is ready, which usually takes about a couple of hours, once we upload that to YouTube, I'll be emailing everyone later tonight, presuming that video is ready tonight. If not, early tomorrow morning, you guys will have an email in your inbox with the link to the webinar. Robert, can you post record dates or ex-div dates? Robert, that's something that we are currently actively working on. So currently we're showing earnings date here in the bottom. In our next release, we will have dividends. So you will have the next ex-dividend date if we know it. If we don't know the ex-dividend date, it will just simply give you the dividend amount. So that is something that we are working on and is ready. We've actually completed the work for this. It's just going to be part of the next release. All right, so any other questions regarding anything that we've gone over? We can go through, if those of you who have a specific stock in mind, we can go through a specific example if you'd like, or any questions regarding, finding the optimal cover call or income strategies. Feel free to enter them into the chat window, which is to your left of your screen. Vince has got some Apple 125 calls. Vince, what I meant more is, specific covered call opportunities. If you have a specific trade in mind, we can talk about that offline. You can shoot me an email afterwards. So for those of you who are new to this platform, when you need something, no need to be sorry. I'm just saying that if you had a stock that you want to look at, we can go through finding the optimal cover call. For those of you who are new to this platform, if you have a question about a trade, if you have a question about a functionality on the platform, there's this button here on the upper right that says Ask Us. You don't have to leave the platform, you don't have to email us. You can ask questions directly from this chat window. Once you hit next, it'll send that ticket to us and we'll be able to respond directly from there. So you don't have to leave your platform. So if you have a specific trade in mind, and this is something that I want to show you guys that you have access to. If, let's say, Vincent, if you have a specific option that you want to ask us about, you can click on the share button, and what it does is that you can create a link for that specific trade that you're asking about. So, for example, if I'm looking at the February 17th 115 calls, as you can see, what it does is it takes a snapshot of the trade that you're looking at. You can copy it. And then you can type us a question and say, hey, I have some questions. And then you can attach that link and send it to us. And what that will do is it will send that question to us, and it will also have the link so we know what trade you're referring to. A quick way for you guys to send questions regarding specific trades to us. Myron's asking, what is the meaning of beta? Beta is a fairly widely used metric to determine how sensitive the stock is compared to the overall market. So a beta of 1.25 means that if the S&P 500 moves up 1%, you should approximately expect Apple to go up by 1.25%. So it's a measurement for how sensitive the stock is compared to the overall market. David's asking, so as you can see here on the upper left here, there's a portfolio button that is on my screen, but you guys don't see it, is because this is something that we're currently in the middle of development for And this is something that I've been telling users about to be excited about, and I'm sorry that it's being a little delayed, but this is really the next generation of options play, because everything that I've talked about today is helping you find the trade to get into, but once you're in that trade, you still have to manage that yourself. So OptionsPlay Portfolio is our next product, and is the project that we've been working on very actively. It's something that I'm testing every single day to make sure that it's perfect for you guys. But what it will do is it will allow you to enter your portfolio details, and it will actually track the positions that you have and show you if there's something to do on the underlying stock or underlying positions that you have. So if you have a cover call, it will actually tell you it's time to roll your cover call, or it's time to take profit, or it's time, there's a dividend assignment risk and you need to close it out. So these are the type of things that we're doing. And if you're the type of trader that maybe income's not your thing, you just like to buy calls and puts, it will also give you advice and show you when it's time to take profit, when it's time to cut your losses. So that's what we're actively working on. And David, it's something that I hope to get out in the next month or so to everyone for beta testing. This is something that's very exciting. We've been working on for a while, so we're very excited to launch that soon. So everyone that has a subscription to OptionsPlay will receive that invitation for the beta, and you'll be able to test this product with us if you have a subscription when we launch it. Any other questions regarding what we talked about today? The question about real-time versus delayed barrel, you can shoot me an email or just shoot me a message on this questions tab, and I'll be able to answer your questions regarding that. Thanks, everyone. I hope each one of you found this useful. Again, when you're using this, just click on the income tab, put in your preferences, and set up your watch list. It'll save you guys a lot of time in finding the right income opportunity. More importantly, if there's no income opportunity, it'll let you know immediately so you don't waste any more time. All right, everyone, so I'm going to end this webinar now. And again, like I said, in a couple of hours, once the recording is ready, I'll email each and every single one of you so you'll have a link to this recording. Thanks, everyone, for attending. And like I said, next week, we'll be doing another one. It'll be more on trading. So if those of you who are looking to find bullish or bearish opportunities on a specific stock, you want to trade credit spreads, maybe you want to do something even crazier like trade iron condors or butterflies, we're going to cover that next week. So look out for an email for that, probably going out Monday or Tuesday to register for that webinar. Thanks everyone for attending, and I hope everyone has a great afternoon.